Imagine going to a store in Japan and buying sushi for 500 yen. Sounds expensive, right? But wait, that's just about $3. Sounds confusing. Why is 500 of one currency worth just 3 of another? Why can't all currencies be equal? Like $1 equals 1 rupee, 1 euro, or 1 yen? Well, buckle up. Today we're diving into a surprisingly deep rabbit hole to understand why different currencies have different values. And trust me, it's not just about numbers. It's about power, trust, history, and even a bit of psychology. Let's start simple. A currency's value is basically how much of it you need to buy something. It's like a price tag, but for money itself. Now here's the twist. Currencies don't have value just because a government says so. Most currencies today are fiat money. They're not backed by gold or silver anymore. Their value comes from trust. Trust in the country's economy. Trust in its government. Trust that this colorful piece of paper or digital number will still be useful tomorrow. So if people stop believing in a currency, it can become worthless overnight. Think Zimbabwe, Venezuela, or even ancient Rome. Okay, so why is the US dollar stronger than, say, the Indian rupee? It comes down to a classic economic duo, demand and supply. Currencies are traded in the global market. If more people want a currency, say, because they want to invest in that country, buy its products, or stash cash safely, then demand rises, and so does the value. Now flip it. If a country prints more and more of its currency without backing it with strong economic growth, the supply balloons and value drops. So yes, the value of money depends partly on how much of it there is, but more importantly, how many people want it. Let's talk about 3 sneaky forces: interest rates, inflation, and trust. If a country's central bank offers high interest rates, global investors might pour money into its bonds or banks. That increases demand for the local currency. Boom, value goes up. But if inflation is high, meaning prices keep rising, then the currency loses purchasing power. That's like owning a melting ice cream cone. It vanishes before you enjoy it. And then there's trust again. Political instability, poor governance, economic uncertainty, these shake investor confidence. And the currency can crash, even if the country's natural resources or population are strong. Here's something most people don't know. Some countries manipulate their currencies on purpose. Yes, you heard that right. They'll artificially keep their currency weaker to make exports cheaper and boost trade. That's what China has been accused of many times. Others peg their currency to a stronger one like the US dollar. For example, Saudi Arabia pegs its currency to the dollar because it helps stabilize oil prices. But pegging comes at a cost. You lose the ability to control your own economy fully. So next time you see that 1 USD equals 83 Indian rupees, remember, this isn't just math. It's history, global politics, economic performance, public trust, and sometimes straight up strategy. The value of a currency tells a story about how strong or weak a country feels, about what people believe, and about who's really in charge of the global money game. And maybe, just maybe, it'll make you think twice before saying it's just money, because behind every currency is power.